Good morning. It's Jeffrey Christian of CPM Group. It's about 11:35 on Tuesday, the 4th of April here in New York. A lot's happening right now. Gold prices have spiked to higher today. They've gone up to about 2,043, close to their record intraday high of 2,060-something last March. Silver is over $25. It's up it was up more than $1 at one point today. And they're reacting to a variety of things: higher oil prices, a job openings report that might suggest, to some people at least, weakness in the jobs markets, and other things which have caused the dollar and interest rates to both decline. So there's a lot to cover today. We had started the year, late last year, early this year, our videos were talking about how we saw the year 2023 to be a year of transition, and a year of transition across a wide range of issues: economic, financial market, political, personal. And I think that what we're seeing right now is exactly that. People have continually asked us, and we've continually spoken about, what will be the cause of the next big recession or the next political storm? What's going to cause that? And we have repeatedly said recessions and political issues and financial market problems occur because of a combination of factors coming together in growing worse simultaneously. It's never, or it's hardly ever, one thing that causes the next recession or the next financial crisis. And that's what we're seeing right now. We're seeing concerns over bank industry stability. We have had a couple bank problems over the last month in the course of March, and gold prices have responded by rising. Silver too. Silver prices rose very strongly in March, and they basically caught up with what gold was doing in January and February when silver was kind of lagging. The job opportunities report, I'll show you a chart in a second. I think that, there could be some misreading going on into what that is. Our expectation is, let me just go back here. These are our gold and silver prices through yesterday. You can see that gold was testing 2,000 yesterday. It broke above it. We had issued a trade recommendation yesterday saying that if you got to prices at 2010, you might want to reevaluate it. And if it goes over 2010, you might want to buy. And it blew right through 2010 when the job openings report came out today. It went to 2040. It's off a little bit, about 2038 the last I looked just before recording this. Silver was testing, trying to prove that it could stay above $24 an ounce. And in fact, it went above $25 an ounce this morning. One of the factors, the occasion for those spikes, was the jobs opening and labor turnover survey that was released by the Bureau of Labor. And you can see from this chart, the number of job openings were at the lowest level in 21 months. You can also see from this chart that the jobs openings remain a multiple of historic levels. So what we saw were fewer job openings left unfilled, but still very high levels compared to pre-pandemic realities. And I think that's important because what we saw today was the financial markets looking at the sharp drop in jobs openings and saying, the Fed is going to have it. This is another piece of evidence that's reconfirming our predisposition to believing and insisting that the Fed is going to have to stop raising interest rates and start lowering it much sooner than the Fed thinks and says it's going to do. So looking for justification for the idea that interest rates have got to stop rising and have to fall. And one of the big questions is, Yeah, is the Fed misreading the economy, or is the financial markets misreading the Fed and the economy? And we'll find out. The next FOMC meeting is in May, but little known fact probably in the markets today, the reality is that the Federal Reserve Board can change interest rates at any point. It does not have to wait for a meeting of the FOMC. It can call a telephonic meeting and make a change in interest rates at any time that it wants. It tends to do it at FOMC meetings, but it can actually intervene in the markets and change interest rates at any point. I don't think it's going to, but I think that that's something that's worth noting, because there's a lot of suppositions about the Fed and the Fed's policies and the Fed's intentions and the Fed's future actions. And I worry, and I think to some extent the other analysts at CPM Group will worry, that the markets may be misreading not only the Fed's policies, intentions, and likely future actions, but also other central banks' policies. As I said, the market has this predisposition to seeing interest rates stop and interest rates falling. The Fed and other central banks recently have increased their interest rates. The Fed has said that it expects to raise interest rates at least one more time, probably at the FOMC meeting in late May, and that it foresees interest rates remaining relatively high, around 5% or so, for an extended period of time, until we start seeing economic weakness. The question is, are we seeing what we have described as the foothills, a precursor to a more serious combination of factors, or is this the beginning of that big thing? Our expectation is still that it is the precursor, that we will probably see financial markets say, oh, we have been misreading the Fed. It may not occur until the Fed raises interest rates. Let's fast forward into May, the end of May, and the FOMC meets. They raise interest rates another 25 basis points. The banking industry has not collapsed. Economic data comes out showing that while the economy is slowing, it still has a lot of oomph left to it. Jobs report comes out this Friday and says, okay, yes, we do have people now coming back into the workforce, taking jobs and reducing the number of job openings, but we still have twice as many job openings as we used to have on a regular basis, and a lot of jobs going unfulfilled. So it's possible that you could see the markets say, we have been misreading the economy and Fed policy, and interest rates aren't going to, quote, pivot as soon as we think, and that 5% interest rates really isn't so high as to turn off economic activity. And then the correction, when such a misreading is realized, could be very painful for a lot of investments. So gold and silver prices may remain high for now, but they are vulnerable to a downward correction along with a lot of other markets should things change. That's one of the factors that's there. The unemployment report. Interest rates, I think we've talked about, misreading. Next one is oil prices. There was a sharp decline announced in production. I'm sorry. You have to be very careful with OPEC and OPEC Plus. OPEC announced a commitment to reduce production. Sometimes OPEC announces increases and decreases in production that don't actually occur. There's a compliance issue with OPEC's agreements and what its members actually do. But on Sunday, OPEC Plus, which includes Russia, made an unscheduled announcement that it was reducing oil output by 1.16 million barrels per day to 3.66 million barrels per day. That's a 24% cut in OPEC production. That's really a dramatic factor. And we have seen the oil price rise sharply from around $66 in March to around $81 for WTI today. Putting it in a broader context, it's a 3.7% decline in world production to 31 million barrels per day. So OPEC is less important to oil than a lot of people think it is. Prices they had risen 5.5% yesterday. They've risen further today. WTI peaked last June at $122 a barrel. It bottomed at $66 in the middle of March. A 46% decline in prices over 9 months. No one should have been surprised that OPEC Plus cut production. Production costs at a lot of OPEC Plus members, including Russia, are very high. I got into trouble a year ago when I was talking about the average cost of production within Russia, and I put out a number which basically pointed out that that Russia had been suffering from lower oil prices earlier, and certain Russian oil producers pointed out to me that their costs were very lower, and I said that's true. But on average, the Russian cost of production is relatively high. So too are the costs in Iran and Nigeria and Venezuela. And you saw at $66 a lot of oil exporting countries and OPEC members and Russia losing money on every barrel of oil that they shipped out. And by the way, the vast majority, the largest portion of Russian trade over the last year has continued to be in the U.S. dollar settlement. It has declined, the U.S. dollar settlements, but it is still the bulk of Russian trade settled in U.S. dollars. So when you start hearing people talk about how the Russians don't use the dollar anymore, don't believe it. Also, the state of international affairs. They're very important to the oil price. They're very important to oil. We've gotten China coming in and helping broker a partial rapprochement between Iran and Saudi Arabia in that they reopened their embassies, which they had closed a few years ago. They're still bitter rivals, but, the enemy of my enemy is my friend, and the enemy of my enemy can be my enemy too, in which case I'm going to befriend my enemy. So the politics are much more complicated than the simplistic views you'll hear from talking heads on television and on the internet, and you have to watch out for that. Oil prices have risen. It's not clear how much higher they will rise. The dollar has fallen. It's not much clearer how much more dollar weakness we may see. Politics continue to be problematic. Internationally, you still have the U.S. versus China, and that's growing probably worse. The Russian war in Ukraine continues. Finland is joining NATO. NATO is supplying advanced tanks and old Soviet-era jets to Ukraine, which could actually turn the war. There are increasing signs of cracks within the Russian government and Russian military that remain to be seen how that's all going to shake out. And then there's U.S. domestic politics, France, the UK, Hungary, Germany, Turkey. There are a range of Islamic countries that have problems, and China is probably having some internal discussions within the Communist Party of China about the direction of the country. So there is a combination of factors that have caused investors to increase their interest in gold and silver over the last 2 days and over the last few weeks, and that has led to this elevated price in gold and silver. We still think that the prices will rise sharply. We do think that there is the potential for prices to come off in the second and third quarters of this year on a temporary basis before we see a more forceful upward move, possibly later this year, more likely in our mind in 2024. Because we think that all of that litany of issues that I just ran through will probably be even more problematic for economic growth in 2024 than they are in 2023. That's pretty much what I've got to say today. I will say the Gold Yearbook, our annual review and outlook of gold, is out now. We released it late last week, or actually Tuesday of last week. You can buy it online, download it. It's an ebook. It's about 240 pages or so. You can buy that. And you can pre-order, not pro-order, but you can proactively order our Silver Yearbook and our Platinum Yearbooks. I've been making a mistake in saying that the Silver Yearbook would be launched in late April. Actually, we'll launch it on the 16th of May. We have a variety of other issues, things that we have to do in late April and early May. So we will be launching the Silver Yearbook on May 16th with an online briefing. You can pre-order that book. You can pre-order the Platinum Group Metals Yearbook, which we will release in July. That's about all I have right now. Go to YouTube and see our earlier videos. You can go to our website and download a variety of things, including some of our videos and some of our free reports and presentations and speeches. And you can buy some of our research if you need it. Take care and enjoy yourself.